Something strange is happening in the silver market right now, and most people don't even realize it yet. What you're seeing on the screen is not a normal market behavior, and once you understand it, you may never look at silver prices the same way again. Just days ago, massive amounts of silver were dumped into the market without warning. Not slowly, not carefully, but aggressively, as if price no longer mattered. This is the kind of move that makes experienced traders pause and ask one dangerous question. Is this even a real market anymore, or just a controlled illusion? If you've been watching silver for years, you already know this doesn't feel natural. Prices fall fast on no news, recover weakly, and then get slammed again with perfect timing. This isn't panic selling by regular investors. This is calculated, coordinated, and designed to send a message. Before we go any further, if you care about honest analysis on gold, silver, and real money, make sure you subscribe to Bullion Alert HQ right now. We break down what mainstream financial media refuses to explain. You don't want to miss what's coming next. Now here's the part that should really concern you. Physical silver demand is rising, premiums are staying high, and yet the paper price keeps getting crushed. That alone should make you stop and think. In a real market, price reflects supply and demand, not scripted sell-offs. So who is dumping silver, and why would they do it at these levels? More importantly, why does it keep happening at the exact moments when silver starts to gain momentum? This pattern has repeated over and over for years. Every time silver shows strength, massive sell orders appear out of nowhere. These are not small trades placed by emotional retail investors. These are institutional-sized positions designed to overwhelm the market instantly. Imagine walking into a store where demand is exploding, shelves are getting empty, but the price tag keeps falling. That's exactly what's happening in silver right now. This disconnect tells us something is broken. Either the market is lying or the price is being forced to lie. And if you're wondering whether this matters to you, the answer is yes, more than ever. Silver isn't just a metal, it's a signal. Throughout history, silver has exposed stress in the financial system before the headlines catch up. When silver behaves irrationally, it usually means something much bigger is happening behind the scenes. Right now, central banks are trapped. Debt levels are exploding, interest payments are crushing budgets, and confidence in fiat currency is quietly eroding. Silver and gold are not supposed to rise slowly in that environment. They are supposed to scream. So when silver is violently pushed down instead, you have to ask who benefits from keeping it quiet. The answer is not everyday people. Low silver prices protect the illusion of stability. They help maintain confidence in paper assets, bonds, and currencies that are under enormous stress. This is why silver has always been the most manipulated market in the world. It's small enough to control, but important enough to matter. Now think about this carefully. If silver were allowed to trade freely, what would it say about inflation, debt, and monetary policy? It would expose the truth far too quickly. And that truth is not convenient right now. That's why these dumps feel emotional, sudden, and violent. They are not reactions, they are interventions. If you're new here, this is exactly why Bullion Alert HQ exists. We focus on what markets are hiding, not what they want you to see. Let's talk about the timing, because timing reveals intent. Well, these silver sell-offs often happen during low liquidity hours when fewer buyers can respond. That's not accidental. It maximizes impact while minimizing resistance. In a real market, sellers care about getting the best price. In this market, the goal seems to be smashing price, not selling efficiently. That alone tells you this isn't about profit. It's about control. And here's where most people get it wrong. They think this means silver is weak. In reality, manipulation only happens where something is strong and dangerous to the system. Nobody manipulates assets that don't matter. Silver matters because it exposes inflation in a way numbers can't hide. It reflects the loss of purchasing power instantly. When silver rises sharply, it sends a message to the public that something is wrong. That message must be delayed as long as possible. So silver gets dumped again and again. But here's the part no one tells you. Every artificial move builds pressure underneath. Like holding a beach ball underwater, the longer it's forced down, the more violent the release when control slips. Markets always win in the end. This is why physical silver keeps disappearing despite falling prices. Smart money isn't watching the chart, they're watching reality. They understand that paper price is temporary, but physical supply is finite. Once trust breaks, price becomes irrelevant. And trust is already cracking. Banks are more fragile than they appear. Debt markets are stretched thin, and confidence is being held together by messaging. Silver is not reacting because it's being restrained, but restraint cannot last forever. If you've made it this far, you're already ahead of most viewers. Stay with me, because what comes next explains why the next move in silver could shock everyone. Now let's talk about where this road actually leads. Because markets can lie for a while, but they cannot lie forever. At some point, pressure reaches a breaking level, and when silver finally responds, it won't move politely. This is the part most people underestimate. They expect a slow climb, but suppressed markets tend to explode. When confidence breaks, Price discovery happens all at once. There's no warning bell. One day silver looks weak and forgotten. The next day everyone is asking why it's suddenly moving faster than expected. This shock doesn't come from news headlines. It comes from structure breaking underneath the surface. It could start with something small, a delivery delay, a sudden inventory drop, or a large buyer refusing paper settlement. These moments don't look dramatic at first, but they spread quietly through the system. Once participants realize paper promises are fragile, behavior changes instantly. Demand shifts from trading to owning. That transition is dangerous for a leveraged market, because leverage works both ways. When too many contracts chase too little metal, price loses its anchor. That's when volatility turns violent. This is why silver's silence is deceptive. Calm does not mean safe. Right now, most investors are distracted. Stocks, tech, and headlines pull attention away from metals. That's exactly when structural shifts happen. Quiet periods create the biggest surprises. Another mistake people make is waiting for confirmation from mainstream media. By the time confirmation arrives, the move is already advanced. Silver has always moved before permission is granted. It doesn't wait for approval. This isn't about fear, it's about awareness. Silver isn't a trade for moments of excitement. It's a position for moments of realization. And realization tends to come suddenly, usually after something breaks. When that happens, narratives flip overnight. What was ignored becomes obvious. Those who waited for clarity realize clarity has a cost. That cost is paid in higher prices. This is why understanding manipulation matters. Not to complain, but to prepare. Suppressed prices are not a warning sign to run. They are a signal to pay attention. The longer distortion lasts, the sharper the correction tends to be. History has proven this again and again. Now here's something important to remember. Nobody rings a bell when control ends. There is no countdown, no announcement. One moment the market behaves normally, the next moment it doesn't. And when silver moves, it doesn't ask who is ready. It moves because it must. This is why emotional reactions fail. Panic buying and panic selling both destroy outcomes. Calm observation beats prediction. Understanding beats guessing. If you've stayed with Bullion Alert HQ until this point, you already know this channel isn't about hype. It's about reading the signals others ignore. Silver being dumped is not a sign of weakness. It's a sign of fear somewhere higher up the chain. Real markets don't need force. Only controlled markets do. The question is not whether this system will change. The question is how prepared people are when it does. And that's where you come in. Awareness is your advantage. Before we wrap up, I want to hear from you. Do you believe silver is being controlled, or do you think this is just normal market behavior? Drop your thoughts in the comments below. Your perspective matters more than you think. If this video helped you see the market differently, share it with someone who still trusts the price on the screen. Sometimes, one conversation is enough to open eyes. And if you haven't already, make sure you're subscribed to Bullion Alert HQ. We're just getting started, and what comes next may surprise a lot of people. Stay curious, stay patient, and stay alert. Because when the real move begins, it won't wait for anyone. To really understand what's happening, you have to separate paper silver from physical silver. Most people think they're the same thing, but in reality, they behave like two completely different worlds. Paper silver is traded in massive volumes with a click. Physical silver has to be mined, refined, transported, and stored, and that process can't be sped up by algorithms. Right now, the paper market is drowning in contracts. There are far more claims on silver than actual metal available. This works fine as long as nobody asks for delivery. The problem begins when confidence fades and people want the real thing. And that's exactly what we're seeing. Demand for physical silver keeps rising quietly while paper prices are being pushed lower loudly. This creates a dangerous imbalance. It's like writing checks from an account that doesn't have enough cash to cover them. The COMEX plays a huge role in this system. It sets the global paper price that the world is told to believe. But here's the uncomfortable truth. COMEX pricing is based on futures contracts, not on actual physical transactions most people interact with. That means the price of silver you see on the screen is often just the price of leveraged bets. It's not the price of holding a real ounce in your hand. When large players dump silver futures, they don't need to own the metal. They just need enough capital to move sentiment. And sentiment is powerful. Once fear enters, algorithms react, stop losses trigger, and the drop accelerates. This creates the illusion of a collapsing market. But behind the scenes, physical buyers quietly step in. Dealers don't see panic. They see steady demand and shrinking inventory. Premiums staying high during price drops is a massive red flag. In a real market, falling prices should bring cheaper physical metal. But that's not what's happening. It's getting harder, not easier, to source silver. This tells us the paper price is disconnected from reality. It's a signal, not a reflection. Banks understand this better than anyone. That's why many large institutions are positioned on both sides of the trade. They profit from volatility while the public gets confused. Up looks fake, down looks scary, and uncertainty keeps people inactive. Inactivity is the goal. A calm public doesn't ask hard questions. But when silver moves violently, it forces attention. That attention is dangerous during periods of financial stress. Think about what's happening globally. Inflation may be reported as cooling, but everyday costs tell a different story. People feel it when they buy groceries, pay rent, or fill their gas tanks. Silver reflects that feeling faster than official data. That's why silver must be controlled. It translates discomfort into a visible price signal. Now let's talk about why these dumps feel so aggressive lately. The financial system is running out of room. Debt has reached levels that can't be sustained without constant intervention. Interest payments alone are becoming a crisis. In that environment, any asset that signals loss of trust becomes a threat. Silver is one of the first to raise its hand. So when silver starts to rise, it gets slapped down. Not because it's wrong, but because it's early. Markets hate early warnings. They prefer surprises after it's too late to react. This is where most investors make a mistake. They assume manipulation means silver is a bad investment. In reality, manipulation confirms silver's importance. You don't suppress something that doesn't matter. Every forced sell creates another layer of tension. Every fake drop trains smart money to buy quietly. And while charts look weak, fundamentals quietly strengthen. That gap cannot exist forever. Eventually, something breaks. It could be a delivery failure, a confidence shock, or a sudden surge in demand. When that happens, paper sellers rush to exit at the same time, and that's when the illusion collapses. Prices don't move gradually in moments like that. They gap, spike, and shock everyone watching. This is why patience matters more than prediction. Timing manipulation is impossible, but recognizing distortion is not. If you're still listening, you already understand more than most market participants. Stay with me, because the final part explains what this means for the future and what signals to watch closely.